Donald Trump just called the Federal Reserve a disaster. And most people think this is just political noise. It's not. Because when someone like Trump openly attacks Jerome Powell, it usually means one thing behind the scenes. Pressure is building inside the system. And if you understand what that pressure leads to, you might be early to the next big move in crypto. But here's the part nobody is talking about. This isn't really about Trump. This isn't even really about Powell. This is about control over money. And right now, that control is being challenged. Because what's happening between the White House and the Federal Reserve right now isn't just political noise. It's a stress test, a live, real-time stress test of the most powerful financial institution on the planet. And crypto? Crypto is watching every single move. And here's what no one is telling you right now. The outcome of this isn't just about interest rates. It's about which asset class gets to absorb the fallout when the pressure finally becomes too much to hold. Stay with me. Because what I'm about to walk you through changes how you look at everything happening in markets right now. And if you're serious about being early, not reacting, not chasing, this is the breakdown you need before most people figure it out. Quick note before we go deep. Nothing in this video is financial advice. This is analysis and perspective. Always do your own research before making any financial decisions. If you're new here, welcome to the Wealth Continuum. If this kind of breakdown is what you're looking for, hit subscribe. We stay ahead of the narrative, not behind it. Now let's get into it. So here's where we are right now in early May of 2026. The pressure between the Trump administration and the Federal Reserve has reached a level most people haven't seen in modern financial history. Trump has been publicly and aggressively calling out Jerome Powell and the Fed for months now. The language has escalated. Words like disaster, words like too slow, words like destroying the economy. And while most commentators are treating this like a political sideshow, the people who understand how markets actually work are reading something very different in those words. They're reading a signal. Not about politics, about what's coming next for liquidity. And if you understand what liquidity does to crypto, really understand it, then you already feel why this matters. But let's build this from the ground up, because the stakes are higher than most people realize. Here's the thing about the Federal Reserve that most people never really internalize. It's not supposed to answer to anyone. That's the design. The Fed is structurally independent from the executive branch. It was built that way on purpose, so that monetary policy decisions aren't made based on political timelines, election cycles, or what's convenient for whoever is sitting in the White House. The idea was simple. Keep money policy out of politics, and you reduce the risk of inflation being used as a short-term political tool. That's the theory. In practice, the relationship has always been more complicated than the textbooks admit. But what's happening right now is something different in scale and in tone. Because when a sitting president publicly calls the Fed chair a disaster, repeatedly, and begins floating the idea of removing him. That's not just criticism. That's an attempt to reshape the institutional boundary. And markets notice. Now here's where this gets interesting. And this is the part most financial media is glossing over. The question isn't whether Trump is right or wrong about interest rates. The question is what this kind of pressure actually does to the system. Because institutions, even powerful ones, respond to sustained pressure. And what we're watching right now is the kind of sustained pressure that eventually produces one of two outcomes. I'll come back to both of those outcomes in a minute. But first, let me explain why this matters so much to crypto specifically. Because there's a layer here that most people are completely skipping. Morning, afternoon, or night for you right now? Drop it in the comments. I'm always curious who's tuning in and from where. Let's talk about liquidity. Because if you want to understand crypto cycles, truly understand them, not just ride them blindly, you have to understand liquidity. Liquidity is, in simple terms, how much money is flowing freely through the financial system. When rates are high, money becomes expensive to borrow. Credit tightens, businesses pull back, investors become more conservative. Capital starts sitting on the sidelines rather than moving into risk assets. That environment is suffocating for crypto, not just because people have less money, but because the psychological environment shifts. When money feels scarce, people protect what they have. They don't bet on asymmetric plays. They don't allocate into volatile, speculative assets. They wait. And crypto, more than almost any other asset class, lives and dies on the flow of capital. But flip that dynamic. Lower rates, cheaper money, easier credit. Suddenly, the calculus changes completely. Risk appetite returns. Capital starts searching for yield, and it starts moving further out on the risk curve. And what sits at the far end of the risk curve? Crypto. This is why, and this is something I want you to really hold on to. Every major crypto cycle in history has been connected in some form or another to a liquidity shift. Not necessarily a tweet, not necessarily a product launch, not necessarily a news headline, a shift in the flow of money. 2020, Fed pumped liquidity into the system at unprecedented speed to combat the pandemic. Crypto exploded. 2022, Fed started the most aggressive rate hiking cycle in decades. Crypto collapsed. 2023 into 2024, rate hike expectations began to soften and pivot speculation began to build. Crypto started recovering long before the first actual rate cut happened. You see the pattern. Markets move on expectation, not just on reality. And right now, the expectation is starting to shift again. Now here's the part nobody is paying attention to. The pressure from the White House on the Fed isn't just public theater. It has real structural implications. Because even if the Fed doesn't officially bow to that pressure, even if Powell holds the line, the mere existence of that pressure creates something in markets that is extremely powerful. Uncertainty. And uncertainty is the most underrated force in financial markets. When investors don't know whether the Fed will hold firm or pivot, or be forced to pivot under political pressure, they start pricing in scenarios, multiple scenarios. And that pricing of multiple scenarios is what creates volatility. It's what creates gaps. And gaps, real gaps between where something is priced today and where it might reprice tomorrow, that's where the real opportunity lives. But you have to be looking for it before the crowd shows up. Comment below if you've been watching this Fed situation closely. I want to know how many of you are tracking this at the macro level, not just the crypto level. Now, let's get to the two scenarios I mentioned, because this is where the analysis gets real. Scenario 1, the Fed pivots faster than expected. This is the scenario where either the political pressure works or the economic data weakens enough that the Fed has no choice but to cut rates. Unemployment starts rising meaningfully. Growth slows. The bond market starts sending distress signals. And the Fed, perhaps earlier than their own guidance suggests, begins cutting. What happens in that world? Liquidity comes back into the system, faster than most people are positioned for. And when liquidity comes back faster than expected, markets don't adjust gradually. They gap. They reprice in days, sometimes hours, not weeks. And assets that were positioned correctly in advance, that benefited from the shift before it became consensus, those are the assets that produce the most violent upside moves. Bitcoin, historically, is one of those assets, not the only one. But Bitcoin in particular has shown a consistent pattern of front-running liquidity expansions. It sniffs them out before they're confirmed. And by the time the mainstream headlines are screaming Bitcoin surges on Fed pivot, most of the move has already happened. The people who made the real money on that move, they were already positioned. They were reading signals like this one. What happens next is the real story, and most people are going to miss the setup entirely. Now, here's scenario 2, and this one deserves just as much attention. Scenario 2, the Fed holds firm. Rates stay higher for longer, despite everything. This might seem like the scenario where nothing happens, but that's exactly wrong. Because if the Fed holds rates elevated while the economy is under this much stress, something breaks. It always does. We've seen this movie before. In 2023, when liquidity was tight and rates were climbing, we saw what happened to regional banks. Silicon Valley Bank, Signature Bank, First Republic. In a matter of days, confidence in an entire segment of the banking system evaporated. The Fed had to respond with emergency liquidity tools almost immediately. That was a small-scale version of what we're talking about. Now imagine that dynamic playing out on a larger scale. If the Fed stays tight and something in the system cracks under pressure, a credit market, a currency, a segment of the banking system, the response isn't going to be gentle. It's going to be fast, and it's going to be large, because that's how interventions work when panic is already spreading. And here's the paradox that most people completely miss. That intervention, that emergency liquidity injection, is ultimately bullish for crypto. The same way 2020 was, the same way post-SVB recovery was, because when trust in the traditional system takes a hit, when people see that the Fed will always print and inject when things go wrong, the thesis for a decentralized, fixed supply asset like Bitcoin gets stronger. Not weaker, stronger. So either way, early pivot or something breaks and then pivot, the end of that road often looks the same. More liquidity, more money looking for a home, and crypto waiting at the door. Hit. Like if this framework is starting to make sense, it changes how you read every macro headline from here. Now I want to zoom in on something specific that I think is being almost completely ignored right now. The market's relationship with the Fed has changed, not in a temporary way, in a structural way. For most of the post-2008 era, there was an implicit understanding in markets. The Fed will step in when things get bad enough. That understanding, sometimes called the Fed put, created a backstop mentality. Investors took more risk because they believed the downside was contained. And when they were right, everything worked. But what happens when that implicit contract starts to feel uncertain? What happens when markets aren't sure whether the Fed is going to act independently, or act politically, or act at all in time? That uncertainty reprices risk, not linearly, abruptly. And crypto, which has always been partly a bet against the traditional financial system's reliability, directly benefits from that uncertainty. Not because people want the system to fail, but because when trust in central systems weakens, alternatives gain credibility. That's the deeper thesis here. And it's one that has been building quietly for years, while most people were distracted by the noise on the surface. Now here's the part nobody is paying attention to. And this is where I want you to really sit with what I'm about to say. The Federal Reserve's credibility is fundamentally a confidence game. It doesn't work if people stop believing it will work. And when a sitting president publicly and repeatedly undermines the Fed's authority, decision-making, and leadership, that's not just political drama. That's a slow erosion of the institutional credibility that makes the entire system function. Now, central banks have survived political pressure before. They've navigated crises before. They'll survive this too, in some form. But every time that credibility takes a hit, every time someone looks at the system and wonders whether it's operating on principle or on political convenience, the case for holding a non-sovereign, non-manipulable asset gets slightly stronger. Bitcoin was created in the wake of the 2008 financial crisis. Its entire design philosophy was a response to the question, what if you can't trust the institutions that control money? That question has never been more publicly relevant than it is right now. Are you positioned for that shift, or just watching it happen? That's the question you need to answer for yourself. Let me pull back for a second and give you the bigger picture, because I don't want this to be a doom and gloom narrative. It's not. The scenario I'm describing isn't necessarily catastrophic. In fact, and this is important, the best case scenario for crypto involves the system working through this stress and coming out the other side with more liquidity in circulation. That's not a crash, that's a transition. And transitions, when you see them coming before everyone else does, are where generational wealth actually gets built, not after the transition is complete. Not when the headlines confirm everything. During the transition, during the uncertainty, during the phase where most people are either frozen by fear or haven't figured out what's happening yet. That's the window. And right now, in May of 2026, that window feels like it's either open or about to open. I'm not saying buy everything today. I'm saying understand what's happening and be intentional about how you respond to it. Because there's a version of the next 6 to 12 months where if you were paying attention to signals like this one, you look back and say, I saw that coming. And there's another version where you look back and say, I knew something was going on. I just didn't do anything about it. Which version do you want? Now let's talk about what to actually watch for. Because analysis without action triggers is just entertainment. First, watch the language coming out of the Fed, not the rate decisions themselves, the language around them. When the Fed starts using phrases like data-dependent more cautiously, or when you start hearing officials acknowledge economic weakness more openly, that's a shift. It doesn't mean a cut is coming tomorrow, but it means the internal conversation is moving, and markets will front-run that conversation long before the cut is announced. Second, watch the bond market. The 2-year Treasury yield specifically. The 2-year is extremely sensitive to where markets expect the Fed to take rates over the near term. When that yield starts falling meaningfully, even before any official announcement, it means bond markets are pricing in a pivot, and bond markets are usually earlier than equity markets on this stuff. Third, watch Bitcoin's behavior during periods of macro stress. This is a newer pattern that's emerged over the last couple of cycles. Bitcoin used to sell off hard with everything else during risk-off events. That correlation has been shifting. Increasingly, Bitcoin is showing signs of being viewed as a macro hedge, not just a speculative risk asset. If we see Bitcoin hold firm or recover quickly during the next moment of traditional market stress, that's a signal that institutional behavior is changing. That's a signal that the narrative is shifting in a very meaningful way. Subscribe if you want to stay ahead of these signals as they develop. I'll be tracking all of this in real time as May and the months ahead unfold. This is where smart money's already moving, and most retail investors are completely asleep at the wheel. Let me give you the broader context on what's really being contested here, because I think this entire situation, Trump versus Powell, White House versus the Fed, is being framed too narrowly by most commentators. They're framing it as a personality conflict. They're framing it as political theater. Some of them are even framing it as a nothing burger. But what's actually being contested is something much more fundamental. It's about who gets to control the narrative around monetary policy. For decades, the Federal Reserve has operated with an almost mythological level of authority. Their decisions were treated as technical, not political. Their chair was treated as a kind of financial pope, infallible, above the fray, speaking in a language that conveyed certainty even when certainty didn't exist. That aura of authority is itself economically valuable. It allows the Fed to manage expectations without always having to take action. Just the implication that the Fed will act is often enough to stabilize markets. But when that aura gets challenged publicly, When that authority is called into question by someone with enormous political reach and media influence, the aura becomes less reliable as a tool. And when the tool becomes less reliable, markets start looking for other anchors, other stores of value, other systems they can trust to operate outside the political cycle. Sound familiar? This is the thesis that has driven crypto adoption at the institutional level for the past several years. And right now, the case for that thesis is getting louder, not quieter. Do you think the traditional financial system can hold under this kind of pressure? Drop your honest take in the comments. I want to know what the community is thinking. Now here's something I want to address directly because I think it's important. Some people watching this will say, this is just doom and gloom crypto hype. I get that. And honestly, healthy skepticism is good. You should push back on narratives, even ones that sound compelling. So let me steal in the counter-argument. The Fed has navigated political pressure before and maintained its independence. Interest rates at current levels are high by recent standards, but not historically unprecedented. The U.S. economy, while showing stress in certain areas, has not collapsed. Corporate earnings have been mixed, but not catastrophic. And crypto itself has had false dawns before. Moments where the macro setup looked perfect and then something unexpected derailed the move. All of that is true. None of it invalidates the analysis, because this isn't about predicting that a specific thing will happen. It's about understanding the direction of pressure and the most likely outcomes if that pressure continues to build. And right now, the direction of pressure is pointing toward more monetary uncertainty, more institutional stress, and more appetite for alternatives to the traditional system. You don't have to agree with that to see why it's worth paying attention to. Let's talk about Bitcoin specifically for a moment, because I think Bitcoin's behavior over the past year has been communicating something important that most people aren't reading correctly. Bitcoin is increasingly being held not just by retail speculators, but by institutions, sovereign wealth funds, corporate treasuries, and governments. That shift in who holds Bitcoin changes how it behaves. Retail investors panic sell, institutions hedge, and as the holder base matures and shifts toward longer duration, more sophisticated capital, Bitcoin's volatility profile changes. Its response to macro events changes. Its narrative in the mainstream financial press changes. We are in the middle of that transition right now. And transitions are where the most asymmetric opportunities exist. Because early in a transition, the old narrative is still dominant. Most people still see Bitcoin as a speculative gamble. Most people still see crypto as something for tech enthusiasts and risk takers. But the capital flows tell a different story. The institutional adoption data tells a different story. The on-chain behavior tells a different story. And when the narrative finally catches up to the reality, the repricing is usually fast and significant. Share this with someone who's been sitting on the fence about whether to take this stuff seriously. They need to see this before it's too late. Now here's what I want you to take away from everything we've covered today. This is not about one tweet. It's not about one rate decision. It's not about one political moment. It's about a system under sustained compounding pressure. And systems under sustained compounding pressure behave in predictable ways. They either relieve the pressure gradually, or they hold until something releases it suddenly. Either outcome, as we've established, has historically been positive for crypto over the medium term. What changes is the speed of the move. A gradual easing produces a gradual recovery. A sudden crack followed by an emergency response. That produces a violent, fast repricing that most people get completely wrong, either by being on the wrong side or by being too slow to react. The goal, and this is what the wealth continuum is built around, is to understand what's happening deeply enough that you're not reacting. You're responding with clarity, with intention, before the crowd figures it out. What would you actually do if the Fed pivots in the next 60 to 90 days? How are you thinking about your positioning right now? Tell me in the comments. The conversation there is genuinely valuable. Let me leave you with this. There's a version of the financial world that most people operate in. The version where you wait for confirmation, you wait for the rate cut to be announced. You wait for Bitcoin to break to a new high. You wait for CNBC to run the crypto is back headline. And then you buy. Right at the top of the first big wave. Right when the opportunity that was available to the people who were paying attention has already closed. That's the version most people live in. And it's not because they're not smart. It's because they're not early. Being early doesn't mean being reckless. It doesn't mean betting everything on a prediction. It means understanding the pressures building in the system before they produce the visible event. It means being in the conversation before the conversation goes mainstream. Right now, the conversation about Fed independence, political pressure on monetary policy, liquidity cycles, and crypto as an alternative financial rail, that conversation is still in the early phases. Most people haven't connected these dots yet. Most people are still treating Trump's comments about the Fed as political entertainment. They haven't asked the deeper question. What happens to the money if the system that controls it starts to feel less reliable? That question is the one worth sitting with. Because the answer to that question, the real answer, not the comfortable one, points directly to why crypto is built, why it keeps growing, and why moments of systemic stress often become inflection points for this asset class. We're watching one of those moments build in real time, and whether it resolves quickly or takes the longer, harder road, the direction of the pressure is clear. Stay informed, stay intentional, stay early. If this breakdown changed how you're looking at what's happening right now, subscribe to the Wealth Continuum. This is exactly what we do here. We connect the macro dots before they become obvious to everyone else. Drop a comment telling me what you think happens next. Are we heading toward an early pivot? Or does something have to break first? I read every single one, and I'll see you in the next one.